Good afternoon. This is Chris Robinson, Robinson Ag Marketing, with today's post-close grain and livestock comments for today, Tuesday, September 23rd, 2025. Turnaround Tuesday on light volume. Say what you want to say. It just felt like recovery after the grains just had the snot kicked out of it yesterday. Beans managed penny higher, 10.12 after a 10-cent trading range. Again, the big concern is now, is $10 going to hold? That's what we're going to have to watch here for the next week or so. December corn finished up 4.5 cents, 4.26 and a quarter. Again, I can't get excited about these corn until we fill the gap from July 4th. That 4.32 and 3/4. I would love to see these corn get to the 200-day moving average up at 4.39 and 3/4. That would be a gift. In the meantime, though, what if we don't, right? That's the big key. I don't care what your opinion is. If you've got risk in this market, you need to have some sort of floor under these prices. Now, we haven't had a heck of a lot to work with in 2025 when it came to these corn. We had our high in February, for goodness sakes, 4.79 and 3/4. Slid all the way down to 3.92, 87 cents. So we haven't had a lot to work with. I understand that. But in the meantime, I think that you should protect 420 to 410 corn for the next 30 days. It doesn't cost a lot. And again, it may be the best nickel you ever spent if we come into harvest and we're sub 390 again. And it's okay to be angry. I'd rather be angry about the prices with a hedge than angry and also stuck without a hedge. So that's my thoughts on corn. November beans, the same thing. We had a good run up to 10.62. I thought we might get a chance to hit the high of the year again at 10.75. No dice there. When we didn't get the magical phone call last week with a solution to the Chinese trade issue, the market just really, you saw a lot of people who got long on that phone call getting out of it now, sort of a reset. So 10.12 here seems like a good starting point for the rest of the week. Again, I don't know why you wouldn't protect $10 beans, because I don't want to be sitting here 2 months from now at 9.70 going, oh, well, gee, we didn't think that $10 was worth protecting. You don't have to spend a whole lot to protect those downside in those beans. And again, I'm not talking about selling 3 calls to pay for a put, because I'm like you. If you're a producer, you're always hopeful that we're going to get that rally. Now's not the time to be selling calls to buy puts, because why would you want to do that? It's like you're setting yourself up for failure if we did have a spike. So I hope that we get a recovery. I hope that the stories of there's too much rust out there, and there's the heat shave the yield and all the stuff we all read about. I'm hopeful that we get there. But in the meantime, as a risk manager, you need to defend the revenue that's here in these crops. And so if you're looking for help, take a look at my letter. I try and be very objective. I bring over 30 years of experience into every decision I make. I'm not going to be one of these guys that tells you, trust me, we're going to be, at a certain price, and all you have to do is wait, it'll all turn out. That's complete nonsense. What I want to do is keep you protected until you sell your grain. The other flip side to that is, if we did get a big rally in grain, people are scared to sell it because they think if they sell it, it's going to continue to rally. We have strategies to take care of that as well, too, because you need to be in a situation where if we do get a good rally, that you're comfortable pulling the trigger on a sale. And that's exactly what I hope guys do, day in and day out. If you look at December Chicago wheat, up 10 cents. Again, it's just a dead cat bounce. I mean, that's what it looks like to me. I mean, we made a new contract low yesterday. A bit of a recovery here today. I can't see wheat really getting a big story ahead of us unless we get a bigger and better rally in corn. The news out last night that the Chinese, bought soybeans from South America. I actually saw a little bit of the reason for the rally today. People were thinking that was a reaction to that sale, where people want to re-own those sales. Nothing moves in the United States for us until we get back to where we were with China before. China used to take 25% of our soybeans. We grow 4 billion bushels of soybeans. They used to take 1 billion bushels of it. we need to get that back there. That's the first step. And we all wait together and see if we get some sort of a resolution to this trade deal. Switching over real quick to the live cattle, feeder cattle, protein complex. Unusual to have a day where fat cattle are lower and feeder cattle continue to kind of squeeze higher. I'd look at December fat cattle, a year, 2 months from now, everybody's going to be saying, "Oh, it was so easy to see that 240 was a triple top. Look at all that resistance up there." Until we can take out 240 and then 243, which is the contract high, that's the kind of the fight zone we're going to be in here for a while. But big picture, you've got to look at where we are. Back in September, this contract was trading at 173. 173 to 240. All that revenue is something you need to be protecting. You can reach out to April or June of next year and do some really nice hedges. All that stuff is north of 230. You've got April 240, June at 234, August of next year at 230. So those are all giving you really good opportunities to set some hedges out there. October feeders finished the day up 77 cents. Another $4 trading range, just a whipsaw. Can tell how many times we whipped $2 higher and $2 lower. And again, so they make it very, very, very difficult to put stuff on here with futures. I'm looking at this thing right now. At 9:05, we traded 360. At 10:05, we were trading 364. And then lo and behold, at 12:30, we're back down to 361 and change. So just a up down whipsaw. They make it very, very difficult to hedge with futures. This is a market where you need to be using put options if you're long cattle. You want the floor, but you want to leave the upside open. And in the meantime, you don't get whipped around as we trade around these 5 and sometimes 10-cent trading ranges. Wrapping it up with the hogs, lean hogs, new contract highs. December back north of 90, 90.725. You've got the managed money, who everybody loves to hate when they're bet short, but they love them when they're bet long. They have a record long bet in the lean hogs. You've got, again, December finished up $1.90 at 90.72. February also finished at new contract highs, 91.92. It's giving you great, great opportunities to go out. You can go all the way out to April or May of next year and get some really very, very juicy hedges if you are raising lean hogs. If you look at May of 2026, that chart today, again, new contract highs, 96.250. That market just keeps pushing higher. It's giving producers lots of opportunity to set good hedges. So that's it. If you're looking for a custom fit, if I don't care if you've got 500 acres or 5,000 acres or 25,000 acres, whatever your risk is, there is a hedge that can help defend what you own until you sell it, and then also keep you in the game after you sell it. That's really what good marketing is all about. If you're looking for some help, want to talk about it, give me a call, 312-638-8868. This is Chris Robinson. Have a great rest of the night. We'll be back at it tomorrow morning. If you would like to sign up for my daily letter, please take a look at it, robinsonagmarketing.com. I also have a private client seminar, a webinar I do every Tuesday. I'm going to be working on that tonight. That'll be posted later on tonight. This is Chris Robinson. Have a great rest of the day.